Let's get some insights, the news shaping the markets. For that, we welcome in Fritz Foltz is with us, Chief Investment Strategist at 3Edge. Thank you so much for being with us. There's so much going on, right? Back-to-back monthly losses likely here. A very tough month, down 5% roughly. Jamie Dimon has some comments warning the Fed about raising rates. What are your thoughts on what you're seeing?
Well, first, thank you for having me back. I appreciate it. So we do a weekly video here at 3Edge, and the video this week we called Goldilocks. And the reason that we thought we'd focus on that was, a lot of times people use this expression of a Goldilocks economy or a Goldilocks market. And it just appeared to us that certainly through the first half of this year anyway, investors were, even in the face of the aggressive monetary tightening that we've seen as the Fed tries to get down to their 2% inflation target, investors thought, well, they can do that, and we're going to have an economy that's not going to be too hot, meaning the inflation will be brought under control. It's not going to be too cold, so all this tightening isn't going to cause a severe economic slowdown and lots of unemployment or even a recession, but it's just going to be just right. The economy is going to cool enough, inflation is going to come down, and we're going to have this Goldilocks scenario. And we were really skeptical of this all throughout this year, Billy. We just thought that the concern to us was that there was so much money being invested based on that story, which, it could play out that way, but we just felt you need to be a little skeptical and not just accept that story. So that's why we like to use the expression Goldilocks. And maybe in the last, week with the Fed announcement last week, we've seen Goldilocks maybe exiting the building at this point.
Interesting. Well, at this point now, you also have the government shutdown looming, and that too could slow the economy. But the Fed still seems set on the possibility here of another rate hike or even two.
Yeah, it's such a wild card, the government shutdown, because, there's so many different iterations of this thing that could play out. But really what scared people last week, right, was the Fed. They didn't do anything. But now the Fed analysts are showing that, the funds rate is going to remain above 5% through the end of 2024. And Nicole, remember, it wasn't all that long ago where folks on Wall Street were telling us that by the end, as we enter near the end of this year, we're going to see the Fed was going to have to start cutting interest rates. So this is really, and to us, it really wasn't a surprise. We've been expecting this, but I think far too many investors were complacent, thinking that that was going to be the narrative. But now it really does seem that no, rates are going to be higher for longer. And that means that monetary tightening eventually is going to bite into people who need to finance or refinance, and the cost of capital is now much higher. So it could be a real struggle next year. The government shutdown, a complete wild card.
Yeah. So while the world may not be ready for 7% interest rates, like that's what Jamie was talking about, Jamie Dimon, and at the same time, we're hoping for this soft landing, but you do have the market that has been pulling back, and the question is whether or not there is opportunity here. In fact, with the S&P pulling back 1% today, we've gotten into plenty of economic data even today. We're at the lowest levels since June. Is there opportunity here?
So we're not stock pickers, and we invest at the index level. So that's a little different. But the way that we do our analysis, in our opinion, the S&P 500, for example, is still significantly overvalued. We tend to use price to sales ratios. And in our analysis, we find the S&P, even after the pullback here, is just about as overvalued as it was prior to the bursting of the tech stock bubble back in the 2000s. So for us, for the S&P to look more fairly valued, it would need to come down here quite a bit. Now, that's not to say that some companies within these indices haven't been beaten up to the point where they could be a good long-term buy. But the S&P 500 index to us remains significantly overvalued in spite of the downturns that we've seen over the last couple of months.
Yeah. Tell me a little bit about, I like you had the threats of the Goldilocks economy, and we didn't talk that much about the credit contraction that we've been seeing. I mean, you noted credit contraction, threat of stagflation, and market correction back to fair value. Tell me a little bit about some of those threats.
Yeah, so a real threat here, and again, this gets back to what I said at the beginning, is typically we had all the monetary and fiscal stimulus from the pandemic, and that had the economy recover and it had asset prices go up. And then a very natural result was to have an overheated economy and an overheated market. And the reaction to that by the Federal Reserve, albeit potentially too late, was to start raising interest rates and tightening monetary policy. And when the Fed is doing that, you usually enter into a period called a credit contraction. And it simply means that liquidity is being extracted from the financial system. And that's a very difficult environment. And stocks don't necessarily do well in that environment, nor do bonds. But what was surprising to us is that many on Wall Street were saying that, well, we're not going to have the credit contraction. The economy isn't going to slow down. The economy is just going to keep going up and asset prices are going to rise again. But we would say, no, it's entirely possible that based on the lagged effect of higher interest rates, that credit contraction could just be beginning.
Oh, boy. Okay. Fritz Foltz, great to have you on the show and your insight today. 3 Edge. Thank you, Fritz.